Hello, everyone, and welcome back. Today, we're gonna embark on a new adventure in our quest towards understanding how the finances of a business work. And so far, we have laid a bit of a foundation by having a deeper understanding of what published accounts are. And what we're going to do from this point onwards for the next few videos is we're going to learn how these published accounts are deciphered, how the information that's contained within these published accounts are decoded, are broken down so that everyone who's looking at these published accounts fully understand what the business's performance is currently. Now, you have to remember that there are two parts to publish accounts. You will remember that we've looked at both of these statements, namely the statement of profit or loss, which we also call the income statement, and secondly the statement of financial position, so SOPL and SOFP. And whenever we were discussing these, of course, what we saw was there's a lot of numbers, and there's a lot of different entries that go into it. So for any person who's looking at these set of statements, they might feel a little dazed, a little bit confused when they look at so many numbers, so many entries, different percentages, different projections. So sometimes for different people, it may be difficult to fully understand what these published accounts are saying about the business performance. Now, there are two parts to what I'm saying. First, what the information is, and secondly, who's looking at it. So we know the information contained within these two statements talk about the assets that the business owns, the liabilities and the capital they have, and additionally, how the revenue is coming in and how the expenses or the costs are being covered. Now, who wants to know all of this? It's the stakeholders of a business. Different stakeholders will have different reasons for looking at the same published accounts. Remember, published accounts are made public or made to be viewed by anyone in the general public, which includes the stakeholders. So, different stakeholders, and let's look at them one by one. So, let's say we talk about the government. The government would be very much interested in knowing the profitability of a business because it's upon the profit number that the government would rather apply a tax percentage. So the governments need to know who needs to be taxed and conversely, who needs to be given subsidies. If a business is struggling, they also find that out through their published accounts. Then the managers, they are critical to running a business. And of course, it's the owners who make decisions, yeah, but the managers are implementing them. So their job is to assess whether the business is achieving the organizational objectives. Are they using the resources efficiently? Are there new ways or better ways to minimize the cost of a business? All that falls within the job requirements of a manager. Then we have our customers. Of course, sometimes customers may want to look at the financial situation of a company before deciding to buy because they might be fearful that they may shut down, or maybe there's a company that's bigger than the other one. And this, by looking at the published accounts for the more informed customers, it may give them an idea as to who's the bigger business and whom do you want to buy from. Then you have your investors, super critical. Now, investors are people who are not your shareholders yet. Once they buy the shares, your investors convert into your shareholders. So before they convert into shareholders, the business must be able to show to these investors that it's worth investing in the business, that they're making profits, they're looking towards the future with optimism. So that's something that the published accounts will indicate to your investors. You have your creditors. One of the examples would be your suppliers, and suppliers would like to know your cash position, your liquidity, before deciding to supply to you. So that's something that the creditors, all the suppliers, would get to know from looking at the published accounts. And finally, there's the society. Your society is a critical stakeholder, and in a lot of published accounts now, it's become a requirement to show how they are benefiting the society. What are the steps that are being taken to save the environment or the general living space around the businesses operating. So each stakeholder will have their own reasons for looking at the same published accounts, and different stakeholders will use different ratios, and that's what we're going to be discussing over the next few videos, is the different ratios that these stakeholders use to make better sense of what the published accounts are saying about the business's performance. So in this video, we're going to introduce the different types of ratios that are used by different stakeholders of the business to figure out what the business performance is like. And in total, we're going to learn about 5 types of ratios that are used in ratio analysis, starting with the first one, which is called your profitability ratios. Okay, now your profitability ratios, as the name suggests, is a measure of how the profit performance of a business has been. Are they making profit? Has the investment been worthwhile or not? So if you think about who might be interested in something like this, automatically the stakeholders of managers and shareholders come to mind. Of course, the managers would want to know if they are able to achieve their targets consistently by looking at the profit performance, and the shareholders or your potential investors would also be interested in knowing which companies are making a higher profit because they'd be expected to pay out a higher dividend. Secondly, we're going to learn about liquidity ratios. Now, this is a measure of how easily a business could meet its short-term liabilities. In other words, how liquid are the business's assets? Does the business have cash in their pocket to pay off any short-term expense or liability that comes up? So it's a measure of how well you're meeting your short-term obligations. Of course, there's a couple of stakeholders who are interested in this. Your managers, of course, they want to see how well they're managing their credit, and your suppliers, because your suppliers would ideally like to know if you have the cash to pay for their supplies or not. Thirdly, we're going to go to something called financial efficiency ratios. There are 3 ratios in this category, and financial efficiency ratios are an indicator of how efficiently a business is using its resources and collecting its debt. In simple words, we'll be looking at, is the business able to collect the money that customers owe them quickly enough, and are they paying their suppliers or creditors with a little bit of delay so that it allows for a little bit of liquidity to build up. So when we get there, I'm hopeful that this will make a lot more sense. So it's just about how efficient a business is in using its finance. So again, a couple of stakeholders that are interested are your creditors, because it includes them, and the managers, since they want to keep a close handle on how much credit time is being offered to customers. Fourthly, we're going to go towards shareholder ratios, and as the name suggests, it's for the shareholders or your investors to use. And what are they looking for? They're looking for profitability indicators. So it's an assessment that shows the rate of return on shares and the prospects for investment. Which company is more worthwhile investing in? So of course, and as the name suggests, your shareholders are very much interested in it, your investors, and your competition, because the guy next to you would be interested in knowing how come your shares are trading at a higher rate than theirs. So maybe there's something to learn for them from looking at your shareholder ratios. And lastly, we're going to talk about gearing ratios, and they're going to be a couple that we're going to looking at. And this one examines the degree to which the business is relying on long-term loans to finance its operations. So in simple terms, how much money is the business borrowing from banks to run its operations or to expand the current size of the business? So if you're leaning towards the bank, is that good or bad? That's what we're going to learn when we look at the gearing ratios. Now, just like all the other ratios, there are some stakeholders that are interested in knowing the gearing ratios of a business, and that includes the banks, because they're the ones who are giving the loan in this situation, the managers who want to figure out what the business situation is if they're taking further loans, and of course your investors, because any business that's leaning too much towards taking loans to expand itself means they also have to pay the interest back, and the more interest you have to pay, the less the dividends are for your investors. So as you can see, different ratios have different purposes to different stakeholders, and we're going to look at all of them, starting with the profitability ratios in the next video. So see you there.